So this is joint work with a team from the BIS and with my colleague Wei Jiang at Columbia. And it's thanks to the BIS, we were able to put our hands on all the CoCo issues that have happened since 2009. And so certainly viewed from a US perspective, CoCos was mostly a topic that was discussed by academics. It received some attention in regulatory debates, but in terms of what happened in the market, nothing happened in the market in the US, as I'll show you. And I think what I hope this paper will make you aware of is that a fair amount happened outside the US. And so we will want to partly understand why so little happened in the US and whether things will stay that way. So I'll have some comments about that a little later. But let me start out with putting the study into context, and in particular the context of early proposals and studies and debates in academia mostly. So one of the key pioneers in this area is Flannery, and he has the merit of having written the first paper in 2002. Most of the literature that evolved is post 2008 or 2009. And what did Flannery propose? He proposed that it would be cost efficient for banks to rely on a contingent convertible funding or contingent capital funding, and the product, if you want, that he proposed is a bond with an automatic conversion into common equity if a stock price threshold is hit. When it hits a pre-specified floor, and the floor that he proposed was that common equity market value falls below 4% of total assets. Okay, so he's the precursor, and a lot of the bigger literature followed after the financial crisis. Another proposal, very different, well, in some ways quite different from Flannery's, is Duffy. And if you want, the key difference is that the trigger, instead of being a stock price, is a tangible common equity to a tangible assets ratio. And another version which is worth mentioning, and for each of these proposals, I should mention that there have been multiple authors, and I'm not doing justice to the whole literature here. I just want to illustrate some of the different models. So McDonald proposed two price triggers. One is the stock price of the issuer, and the other one is a financial index threshold. So I will discuss later why you'd want to have two price triggers rather than just one. Okay, so that's the early proposals. Some of you are quite familiar with those, so let me not say more about that. Let me say maybe make a couple of observations about the motivation behind those proposals. Okay, so you might say, well, why should we look at contingent convertible instruments in the first place? Why not just rely on what we know, which is debt and equity? And so here are some here are some basic motivations. And, and these motivations very much remain highly relevant. So first one is that it's a simple substitute for a bank resolution procedure. So having an automatic trigger is great because you don't have to go through a restructuring process to write off debt, for example, or to convert debt into equity. You don't have to go through a resolution process, or you don't have to go to Chapter 11. It's automatic. Second motivation, very much a concern in the aftermath of the crisis, is that it's an ex-ante commitment to private sector involvement. There was all this outcry about bailouts, about bailing out creditors. Some of you here in the audience have written about that, and well, one response could be, well, if we worry about that, let's have banks issue contingent capital instruments. And with that goes a reduced reliance on bailouts, and then third motivation that comes along with that is, of course, it mitigates a moral hazard in lending. Okay, so there's been a very active debate in academia and to some extent in regulatory circles about these early proposals, design of these early proposals. I will not say too much about the debate. I'll give you sort of the punchlines. And before I do that, let me emphasize that if you want, the big takeaway from this debate is that design matters in one way or another. So it's not a simple matter of just putting in a conversion trigger, and then all instruments with different conversion triggers, the ones I've described on the previous slide, they're all roughly the same. They sort of do the same, right? Design matters. That's what the theory tells you. That's to some extent what the regulators worried about is, do we have the right designs? And our study, if there's one takeaway of the study that we've done, is that the data shows you that design matters. I'll give you a very specific way in what way it matters. But here's some of the debates. So there are people who criticize the capital ratio triggers, if you want, a la Duffy, for example. Accounting manipulation is sometimes mentioned as a concern. I would say a bigger concern is that these ratios are difficult to track continuously, and they move slowly. It's along some of the comments we heard in the earlier presentation, the discussions of the earlier presentations. It's a slow-moving variable. Maybe that's not what you're looking for if you want to introduce some form of resilience into the banking system. So stock price instruments, they don't suffer from that. Stock prices react much more quickly. And so that's maybe a potential advantage of stock price instruments. But they've come under fire from one of my colleagues, Suresh Sundaresan, and his co-author at the New York Fed. And they were working on this paper when the New York Fed, at the time when New York Fed was heavily involved in discussing the pros and cons of CoCos. They have contributed to casting doubt on whether this is a good way forward by pointing out that these price trigger CoCos suffer from a form of instability, which sometimes you can summarize as a death spiral. Basically, if you want, the short intuition is that if you're close to the price trigger and you expect the CoCo to convert, so debt into equity, you expect that conversion to be dilutive of equity, then the simple expectation of conversion will force the price of equity down and will trigger conversion. So that's why you have this instability for price trigger. But I think we've learned since thanks to the work of one of my discussants, not just this paper, that actually it's not as bad as they make it. That this death spiral problem is not as bad as. So it might be worth revisiting whether we should consider price trigger CoCos. And then a third concern, which I'll come back to, is that these CoCo instruments are difficult to price, and they're difficult to price because of the fact that they have this automatic feature, which is difficult to put in they're non-standard relative to other contingent claims that we know how to price. Okay, and let me take the opportunity to flag a proposal, my own proposal, which I wrote around that time, but I think has advantages over what I've discussed so far. And these CoCo designs are much easier to price. Okay, so very quickly, what's the proposal? Again, this is a design question. So proposal is to, instead of having an automatic trigger, that's the key difference. Instead of having an automatic trigger, you give the issuer the option to convert. So it's a reverse convertible bond. And you specify in advance what the terms are, the strike price is. And basically what you do then is you are giving the issuer an American option, and so we know how to price those. And the big advantage of setting it up as a reverse convertible bond is that it's a collateralized reverse convertible bond. That is, the money that goes, if you want the commitment to buy equity at a certain price, can be honored because the money is raised up front. Okay, that we argue in this paper that this design has a lot going for it, and has in many ways is maybe a more resilient, more flexible instrument than the ones I've described. To cut a long story short, neither this design nor the price trigger design has been adopted by anybody. Okay, so it's still very much an academic discussion in this respect. What has been adopted is pretty much across the board CoCos that have a capital ratio trigger, a tier 1 capital ratio trigger. Let me give you some examples of early issues. Lloyds Bank in 2009, okay, they have what they call an enhanced capital note. If the core tier 1 capital ratio of Lloyds falls below 5%, this converts into equity. Okay, these are mandatory. The term we will use is for these CoCos these are mandatory conversion CoCos. Here's another example. Rabobank. They also have a tier 1 trigger. But it's a higher one. It's 7%, and this is not a conversion into equity, but a write-down of principal. It's a principal write-down CoCo. That's another design. Here's a third example, Crédit Suisse, which is a conversion into equity and has a higher trigger, and has a different maturity. So basically, I'm giving you these examples because you want to keep in mind that now what we're going to focus on when we look at these CoCos in terms of design is what's the maturity, what's the trigger, is it a mandatory conversion, or is it a principal write-down? Those are the main dimensions. Okay, here's the last, more recent example that I want to highlight, and we're quoting from the description of the terms in the issue. So first of all, notice these are large issues, right? This is a 3 billion issue. Here's again the 7% core tier 1 ratio trigger. What I highlighted here, what I want to emphasize is that or on any date that the FSA instructs Barclays to calculate its core tier 1 common equity tier 1 ratio, and the ratio falls below 7%. So what's important to bear in mind here is that there's not only the fact that that there's an automatic conversion given a trigger, but that the regulators are involved in deciding how, or overseeing at the minimum how this ratio is calculated, when it is calculated. And so there's an element of regulatory discretion that is embedded in these instruments, because who knows when the FSA will send out such instructions. And this is a principal write-down CoCo, and here you are basically writing down 100% of the principal. Okay, so just to summarize, this, if you're worrying about design, I've mentioned a lot about the trigger, the loss absorption mechanism, conversion to equity or principal write-down. The triggers, all of the triggers that have been chosen are mechanical, and what has really not been considered at all is the discretionary path and the market value path. Those have been ruled out so far. Now, what you decide to issue, what design you choose is driven by, demand and supply considerations, but it's also driven by tax considerations, regulatory considerations, and rating considerations. So one of the reasons why I wanted to mention in passing the design that I've proposed with my co-author, Frederick Samama, is that the design, that particular design, while not in existence as described, has a substitute that is similar, and that substitute has been used quite widely by European banks before the financial crisis, and that comes under the term of hybrid debt. And there's a very interesting study of those issues by Boris Vallée. These hybrid debt instruments have an option embedded. It's essentially an option not to call the debt when it's callable. It has a feature like what we've described, and it's been used exactly in the circumstances that you want them to be used. You want conversion to happen when you need more capital, essentially. And when do you need more capital is when you are entering a crisis, when your stock price takes a dive, and the option to convert is then in the money, and then you can it's like if you want a capital line commitment as opposed to a credit line commitment. So that's what's attractive, has a lot of attractive features. It was relied on by banks not because there's so much plan to use that feature, but because it just so happened that this hybrid debt had a favorable regulatory additional tier 1 rating under Basel II. And this rating has disappeared. So these hybrid debt issues, they're now just, those that have been issued before the crisis are outstanding, but there have been no new issues of hybrid debt. And you might wonder, was that a good development or a bad development? So coming back to the regulatory side, so you can see that under Basel III, high trigger CoCos, those that have a conversion rate, a conversion threshold of 5 0.1 something %, those are considered high trigger ratio CoCos, they will count as additional tier 1 capital, and they will help the bank meet its regulatory capital constraints. And then low trigger CoCos can be considered as tier 2. In Europe, where most of these issues have happened, a CoCo, as long as it has not been converted, is considered a debt instrument, and the coupon payments on that are tax deductible. That's not the case in the US, and that may be one important reason why US issuers have not pursued these options. A little bit more about current context, because this is a moving landscape, and I think this is why it's interesting to keep track of this area, is that, as I said, I mean, I'll show you, I'll give you some basic facts. It's a growing source of capital for banks in Europe and elsewhere, but not in the US. There is some concern, we've heard these points raised in the earlier session, that they may be attractive because they have high yields, and that in a very low interest rate environment, investors are gravitating towards those instruments and without being fully aware of the risks, so that's a potential issue. But let me mention a third reason why the current context is moving and why this is an important area to keep track of. And that has to do with the new plans. They have not yet been implemented, but the plans for the new resolution model for G-SIFIs. And that resolution model comes under the term of single point of entry. And the idea behind it, the one-line idea behind that resolution is that you only resolve the holding company of a large financial institution. You don't touch any of the affiliates. And resolving the holding company means essentially writing down long-term debt that's on the liability side of the holding company, either writing it down completely or turning it converting it into equity. Okay, and that's what brings in this other acronym TLAC, which is total loss absorbing capital. And the idea is that well, we're going to ask all these large systemically important financial institutions to raise a lot of long-term debt at the holding company level, sufficient so that they can absorb any loss in any of the affiliates. So they'll never go bust. The affiliates will never go bust. And then the numbers that are being mentioned are like 16% TLAC, 25%. But so just to give you an idea, this is these are large capital requirements. What people discuss is that they talk about is long-term debt that can be written off. While another word for that is contingent convertible bond. Now that's not always the word that's used, but in effect that's what it will be. And so so it's important to understand what these instruments do. Okay, so here's some basic information about how this market has emerged. So this is all in billions of dollars, and you can see that there's been a steady increase in CoCo issuance, and in blue is you have the tier 1 CoCos, and in red you have the tier 2 CoCos. And what's interesting is that tier 1 has grown in importance in recent years. The other breakdown that I'm going to show you, there's a couple of other breakdowns we have in the paper. I don't want to show you all the breakdowns, but here's another very highly relevant breakdown, What you have here in blue is principal write-down CoCos, like the Rabobank one or the Barclays one I've shown you, and the conversion to equity. And what you see is that the blue part is rising. So one of the questions we will ask ourselves in this study is, does it matter whether it's principal write-down versus mandatory conversion into equity? Okay, so just to summarize where we are and how we frame our empirical study, we will consider two roles. Essentially, we're going to frame our discussion, our analysis in terms of two roles for CoCos: loss absorption and risk-taking incentives. We will look at potential benefits of CoCos in terms of a cost-effective solution to boost bank capital, and in line with the second comment, a tool for managing risk-taking incentives. And the potential shortcomings you might worry about are, you might worry about who's holding these instruments, and are the investors in those instruments really cognizant of the risks that they're taking? So that's one thing we want to focus on. And we won't have much to say about the second potential shortcoming, which is that maybe this layer is too thin. So our study, unfortunately, will not have much to say about the second issue. So we're going to ask, for now, I mean, this is a work in progress. Essentially, what we've done in this study, what I will go through is show you some results on what happens at issuance, what happens post-issuance. What we haven't done yet is what happens pre-issuance, and how do you determine who are good candidates for to issue CoCos. So who are, what characteristics, issuer characteristics, should you look for in terms of predicting which issuers will be issuing CoCos. We haven't done that work yet. We're still in the data collection phase for that. But first question, this is really the main question I will be focusing on in my presentation. I think this is where the most interesting results are of our study, is, do CoCos reduce bank insolvency risk? And we're going to look at how the market thinks about that, and the market measure of whether a CoCo issues reduce insolvency risk. It will be the credit default swaps of the issuer. What happens to the credit default swap of the issuer around a CoCo issue? And we will be interested, that explains why I went through maybe a little longer than necessary in the introduction, putting the context. We'll be interested in how much does the design of the CoCo matter in terms of reducing insolvency risk, contrasting principal write-down CoCos and mandatory conversion CoCos. That's the first question. And the second question, we will ask, we will have some evidence, it's suggestive, more like suggestive evidence, that investors do anticipate that they might absorb losses if they buy CoCos. So that's the second question we are asking. Okay. Another distinction is we will focus on is whether whether it matters that the CoCo has a low trigger or a high trigger. That's highly relevant for policy discussions, obviously, especially around, as I said, around bank resolution. So on the first question, impact of CoCo issuance on bank credit default swaps, key question is how does the design of the CoCo impact what should happen to CDS spreads? And this simple table highlights the key difference between mandatory conversion and principal write-down. That's the one you really want to focus on. So if you want, in terms of theory, what would the theory say? The theory says if you're issuing mandatory conversion CoCos, well, you're going to get more loss absorption. That should be lower the spread. You're going to have better aligned incentives in terms of risk-taking because shareholders may be potentially exposed to a loss due to the conversion. You get good incentive effects that should also result in a lower spread. So on net, you expect a lower spread post-issuance for CDS, for the CDS of the issuer. What about principal write-down CoCos? Well, loss absorption helps, so you expect lower spread there. But really the key point, this is really the key point about principal write-down CoCos. They're bad for incentives. Why are they bad for incentives? Because they're a gift to shareholders. You are violating absolute priority by basically imposing a large haircut on the CoCo holders, the creditors, but the shareholders are left, their claims are left untouched. There's no conditionality on wiping out shareholders. So the principal write-down CoCo has embedded in it a reversal of the priority ordering equity versus debt, and that's potentially problematic. And so you would expect that from an incentive point of view, maybe these things are not so desirable.
For the credit event in CDS, let's say for low trigger CoCos, could that coincide with the conversion of the CoCos themselves, or is it
yes.
for sure that the conversion of CoCo is never a credit event, I assume?
Well, not in our data.
Okay.
Yeah, that's a absolutely relevant question. So these CoCos were issued post-crisis. None of them has been tested so far. We cannot do a conversion event study with this data. I should mention, though, that the paper by Boris Vallée that looks at hybrid debt, that paper focuses on, in quotes, conversion, i.e. the issuer's decision to delay calling in the debt on the first date when the debt is callable, and does find that, I mean, it's very complementary to what we're doing. It does find that it has all the desirable properties in terms of enhancing the resilience of the issuers. Okay, and we're looking a little bit at bank characteristics, but mainly the only thing we have so far is conditional on issuing a CoCo. How does the response on the CDS spreads change depending on whether you have a large or a small issuer? Okay, so that's not going very far. So the design, empirical design, it's an event study, right? We're looking at the dates before and after the issuance of CoCos. What is a little bit unusual about CoCos is that, unlike an equity issuance, where it's very clear when the announcement is made that an issuer issues new stock, there is no announcement of a new CoCo issue. It's like the news travels slowly, and so that explains why we're looking at how much the size of the event window matters. And then in terms of issuers, we're looking at advanced economies, and we're excluding Euro area periphery countries, Greece, Portugal, Spain, because there's a lot of noise due to the Euro crisis for those issuers. Okay, so then the benchmark index we're looking at is the iTraxx CDS index, and we're augmenting that with liquid bank names from the region of the issuer. And in terms of what we're computing is we're looking at the prediction error. So we're looking at the difference in return on the CDS of the issuer minus the return on the index CDS. And we are averaging that over the time window, and we're standardizing that. Part of the reason we're doing that is to get more statistical power. So this is a methodology that Chris James has followed in his paper. We're basically following exactly in his footsteps. And then we're also computing proportion of negative prediction errors where the null is 0.5. Okay, and so this is really the main, if you want, the main results that come out of our study so far. And so if you look at the z-value, right? The z-value is the average standardized prediction error. You see that it's negative, meaning that the credit default swaps spread narrows post-issuance. And what the red means it's significant at a 1% level. The dark yellow means it's significant at 5% level, and the bright yellow is 10% level. Okay, so if you put all the CoCos in, 21-day window, it's unambiguously issuance of CoCos reduces the risk of insolvency as perceived by the market at the time of issuance. And the other notable result is that if you separate out principal write-down CoCos versus mandatory conversion, all the effect is in the mandatory conversion CoCos, and the principal write-down CoCos effect is insignificant. So that just highlights the importance of the incentive issue. Okay, and then if you have a higher trigger, it's more significant. Here you have some breakdowns in terms of the issuer size. These are not super important, so let me skip that. And let me emphasize another difference here, although the statistical significance here is weak. If you look at the impact on equity prices, you do find a statistically significant effect for CoCos that have mandatory conversion and with a trigger above 6%. Those are, it's not completely surprising that it all loads up on those CoCos, because those are the ones that are most dilutive for shareholders. Okay, but we don't want to push this because there's all stuff going on around issuance for, can move. The theory is ambiguous on how in what direction equity prices should go. So let me not emphasize that. So let me turn to the second question, and that is, are investors chasing yields? And there could be a reason why they might chase yield. CoCos are very highly complex instruments. These are unorthodox instruments. They earn higher yield than anything else. It's higher than junk. So it's an attractive return. You might say, well, okay, I'm going to go for the high yield, and maybe I don't fully understand what I'm getting involved in. So that's a question it's legitimate to ask. So here we can only do something very back of the envelope in terms of whether there is ignorance about the risks taken. And so what we're looking at is the question: do the investors who buy these CoCos, do they actually put weight, positive probability weight, on a conversion event that might disfigure their claim? And the short answer is, if you look at the correlations between CoCo spread and equity prices, so what the theory would predict is that the CoCo spread should be negatively correlated with the equity price in scenarios where the CoCo is at risk of being disfigured due to conversion. Because basically, if losses build up, if the market expects there are losses building up by the issuer, that will hurt the equity price will go down. but the increased perceived risk on conversion of the CoCo will mean that the spread in the secondary market price, the spread of the CoCo relative to other debt instruments will go up. Okay, so that's really the main correlation we're exploring, and it does. What we find is that indeed the CoCo spread and equity price are negatively correlated, which suggests that there is at least some recognition by investors that they are at risk of conversion. Policy implications. So 2 takeaways here really. In the interest of time, let me not say too much. CoCos are a way. CoCo issuance is a way of reducing insolvency risk. That's clear. That's what the market says. They are attractive to issuers. Now, how much more attractive than equity? That's not something we can say. It matters whether it's mandatory conversion or principal write-down, and if anything, the big takeaway of our study is that principal write-down is not a good idea. It's not a good idea. Unfortunately, principal write-down are the ones that are rising in terms of issuance, and I have some hunches about why that's happening. And then maybe just a last point I want to show you, which is also, I think, very important about the investor base. So I focused on the question, are investors aware of the risks they're taking? Another question is, who should be holding those instruments? Now, certainly you don't want those instruments to be held in the banking sector. You don't want those instruments to be held maybe by insurers. Now, there are some restrictions that insurers impose on investments in CoCos. Now, what's interesting is we try to get information on who the issuers are. It's very difficult to get. That the regulators are saying we're not keeping track of that. We've only got one. I cannot disclose who gave us this data, but we've got only one set of breakdowns, which just as I think is particularly interesting. So it will be my last minute on this. So this is distribution of primary market CoCo bond investors, as I said, for selected AT1 instruments. And what's interesting is you see that asset managers, that's the yellow part, are primarily holding them. Hedge funds are holding them. Private banking, that may be slightly more problematic. Insurance companies, not much. And then other banks, they are really just acting, to the extent that they're holding them, it's just as a market makers in anticipation of offloading those CoCo instruments. So in a way, this is reassuring. This is very reassuring. That is, the risk gets allocated in the right place. But we don't know whether this is representative. So, okay. I see 0 there. So.
Okay, well, I want to thank Doug and Amit for inviting me to discuss this very nice paper. Let me just give you an overview of what I'd like to do. First of all, this paper I think is very unique. It provides some, at least the first insights on how investors react to CoCo issue announcements. And its data set is clearly the most comprehensive to date. So it's probably the most important empirical paper on CoCos. My comments are going to focus on suggestions for refining the paper's model, which actually Patrick didn't really talk about, but there's a model in the first part of the paper to try to come up with predictions on how different securities will react to changes in the bank's asset value. And then I'll make some suggestions on how the empirical work might be extended in some interesting directions. Okay, my first comment on the model is that there's a little bit of a peculiarity, which, at least from what I know about CoCos, the seniority is probably not exactly what happens when we have CoCos that convert to equity. The model assumes that after a very large asset decline, mandatory conversion CoCos, which are the ones that convert to equity, not being written down, I think the implicit assumptions being made is that it converts to a fixed market value of equity and is senior to initial shares, because the assumption is that the initial shareholders are wiped out when the CoCo holders still now have a claim on the equity of the firm. But I think the actual mandatory conversion CoCos tend to convert to a fixed number of new shares. I'm making this comment from a paper by Tobias Berg and Christoph Kasser that recently was published in the Journal of Financial Intermediation. They have a much smaller sample of CoCos. I think it's maybe only 22 CoCo issues. But in the case when they convert to equity, it seems as though there's a fixed conversion ratio so that the CoCos can effectively convert to a fixed number of shares, so that unless all equity is wiped out, the initial shareholders aren't going to be wiped out. In other words, there should be equal seniority in some sense. The model is also used to predict what would be the correlations between different bank securities, which is then used in the last part of the paper. And the way that the model makes these predictions is to think about what happens when the bank's asset value declines. How is it going to affect the value of CoCos? How is it going to affect the value of equity, senior debt, and subordinated debt? I think more emphasis could be made on the conversion terms, because the conversion terms will affect these correlations. Now what do I mean by conversion terms? If when a CoCo converts to equity, the CoCo investors are likely to get more equity value than the principal value of their CoCos, then that would be the case where conversion terms favor the CoCo investors. They actually do well by converting. They get more equity value, and the initial shareholders are heavily diluted. Now, it turns out that in almost all cases where in practice CoCos have been issued, it's just the opposite. But a lot of theoretical, or at least proposals, one by Charlie Calamaris and Dick Herring, would in fact recommend that conversion terms should favor the CoCo investors. That would lead to a reduction in risk-shifting incentives and actually get around the debt overhang problem. Because at conversion, the initial shareholders are heavily diluted, they would want to avoid the triggering of conversion by actually issuing more shares, more equity shares, prior to the trigger being met. Okay? So I think the paper is making the implicit assumption that conversion terms favor the shareholders rather than the CoCo investors. But that could well affect the correlations, because if conversion terms favor the CoCo investors, as the bank's assets decline, the value of CoCos will actually go up. And maybe that's not relevant in current practice, but at least it could be relevant in the future. Okay. Now, what about how do the conversion terms affect the initial shareholders? Well, if conversion terms do in fact favor initial shareholders, which is clearly the case for principal write-downs, because in a principal write-down, the CoCo investors always take a loss relative to their initial principal value. And it turns out that in most mandatory conversion into equity CoCos, the paper I mentioned earlier by Berg and Kasser seems to find that indeed those cases seem to also be in favor of the shareholders and at the expense of the CoCo investors. If that is indeed the case, then correlations may in fact change, because if we're far away from the trigger, if the bank has a lot of asset value and capital, then the value of equity shares will go up in proportion to the assets. But if we get close to the trigger, we can actually have the case where a decline in the bank's asset value or capital could lead to an increase in the value of equity. And that would flip the correlation between equity and CoCos. Now, maybe granted we haven't come across those scenarios yet, but that is in fact a possibility that might be pointed out. And the intuition is that as you get close to the trigger, the shareholders could actually gain by the conversion. And so the equity value will be non-monotonic in the asset value. My last comment on the model is that it assumes that following conversion, if total equity is below the minimum regulatory requirement, then that CoCo value will be maintained, but subordinated debt and possibly senior debt are written down or swapped into new equity to replenish the equity ratio to the minimum. And I think this is maybe somewhat counter to what people think about CoCos as being junior to subordinated and senior debt, at least if they're additional tier 1, rated as additional tier 1 CoCos. More realistically, if you have a conversion and at that point the equity is still below the minimum regulatory requirement, the equity holders, which include the CoCo investors and the initial shareholders, they're going to be forced to either raise new capital or shrink their balance sheet to get their capital ratio back up. And only if they refuse to do so would then equity be wiped out, and then possibly subordinated debt and senior debt wiped out. So this is the so-called point of non-viability. When a bank loses access to the capital markets, then that's when the public is being called in. And that is when subordinated and senior debt can be written down, so-called bail-in debt. Okay, some comments on the empirical analysis. The paper, as Patrick mentioned, tests the statistical significance of CoCo announcement window abnormal returns, either on CDS or equity, for a series of binary subsamples. In each test, the sample of CoCos are split between, for example, principal write-downs or mandatory conversion in equity. Then another test looks at CoCos issued by GSIBs, the global systematically important banks, versus banks that are not systematically important. Now, that's useful. I think it provides some interesting insights, but I was wondering, reading through the paper, that these separate binary comparisons could suffer from omitted variable bias, particularly since there's a lot of differences in these binary tests that the paper uncovers. So I'd also like to see the paper do a multivariate announcement where you could regress each announcement's cumulative abnormal return on a whole vector of CoCo terms and bank characteristics, and perhaps also time year dummies. So that would be something akin to a regression like this, which I think is fairly standard in event studies. The paper mentions that it also has the CoCo's credit spread, the spread of the CoCo over a government bond yield. And I think it'd be very valuable to understand how investors price CoCos as a function of the CoCo terms and bank characteristics, including perhaps the bank's long-term credit rating. So, if we want to think about how do investors who are actually purchasing these CoCos evaluate the risk? Do they, in fact, do so? I think a regression like this of credit spreads on CoCo and bank characteristics would be very, very interesting to do. Now, I want to just point to one empirical result in the paper, which I think Patrick emphasized a little more in his discussion, but I didn't see it maybe emphasized enough in the paper, in that in general, when a bank issues a CoCo, we see a decline in CDS spreads, which you can infer, in fact, investors are thinking that the CoCos do protect the more senior debt. That's not the case with principal write-downs, however, and it's stronger for mandatory conversion into equity. So two results that I think are interesting is that for mandatory conversion announcements, they produce significant CDS spread declines, and there's also this negative equity return at the announcement. For principal write-downs, there's an insignificant decline or change in the CDS spread, and actually looks like about a positive increase in the value of equity. So what might be a rational explanation? I was just trying to say, if indeed investors are pricing these CoCos correctly, and I think that could be figured out maybe from the previous regression on credit spreads, if they are in fact pricing them correctly, what might determine these results? Now these results are for high trigger CoCos, ones that are likely to convert. For mandatory conversion CoCos, more chance to convert before the bank is dead, before the point of non-viability, should be least unfavorable to CoCo investors. And Patrick mentioned this. Why? Because they convert early. The stock price is likely to still be significant, so the CoCo investors are getting some value. They create less risk-shifting incentives, should have lower coupons, and they best protect the senior debt. That could explain why we see these CDS spread declines. Debt overhang implies that any improvement in the value of senior debt, if the CoCos are fairly priced, must come at the expense of a decline in the initial shareholders' equity, and that could explain the negative cumulative abnormal returns on equity. And there's a model by Abdul Jaffe and Chitchi that, in fact, show that is the case in a model with taxes and bankruptcy costs. Now, I think more emphasis, even maybe in the theoretical section of the paper, could be put on this risk-shifting incentives, because for high-trigger principal write-down CoCos, especially those that are completely written off when the trigger is hit, they are certainly most likely to impose losses on the CoCo investors. And as a result, you could have it that the bank is always going to have an incentive when it gets near the trigger to take a lot of risk. And even though you have this CoCo that is providing sort of a buffer of capital to the senior debt investors, that could be offset if the bank, in fact, now has this strong risk-shifting incentives, and that might explain why when a bank issues these types of high-trigger principal write-downs, there's a little change in the spreads. In addition, their high coupons, because they're very risky, should maximize the bank's tax shield, and that could explain why, in fact, the firm value goes up. It could explain the positive cumulative abnormal returns on equity. So to sum up, I think this paper is very important in documenting that not all CoCos are the same. They're not homogeneous instruments. They need to be properly designed to best protect debt holders and to stabilize banks. And in fact, as suggested in the paper, that regulatory policy should really start to discriminate between different types of CoCos, especially those that empirical and theoretical research says would be best. So thank you.
Thank you. I want to thank Doug and Amit for inviting me to discuss this paper. Now, they already had information that I like the paper because I had it at the Summer Institute. So I do like it a lot. I think the topic is really important. The paper is really important. Now they have a number of results on CDS spreads, on equity prices. And so what I will spend my time is, now Patrick talked about that in his presentation. They seem to think that the results on equity are ambiguous on theoretical grounds. And I'm hoping that I will clarify things a little bit. I think they could get more structure on that. And I'm not really convinced that it is the case that equity holders could benefit. I want to talk a little bit about why banks issue CoCos, talk about risk-taking, talk about the empirics, and then kind of go back to Squam Lake. So now we're in Chicago, so we might as well use an M1M benchmark. And think of what happens in that benchmark. Now you keep the investment policy unchanged. Equity now gives you the maximum of the value of the firm minus the default boundary. So in that benchmark, you have to think, well, what happens if you have CoCos? Now, do the CoCos replace debt, or do they replace equity? Okay, so let's assume that they replace debt. Okay, then what that implies is that the boundary, the default boundary becomes lower because the CoCos convert. And so that means that in that world, now the debt that is issued is going to be less risky, and the CDS spreads are going to be lower. Okay, so that's what you would expect in that world. Now, so assuming, kind of the traditional M&M experiment, where you are looking at two different firms that have different capital structures ex ante. So if the CoCo replaces debt, now the spreads are lower on CDS. You could also have this CoCo replace equity. Well, if it replaces equity, then nothing happens to the debt, no? Because the default boundary stays exactly the same. Okay, and so when you think about now what's the impact, what the implications of CoCos are, you have to think about what is it that it's replacing. Now, is it replacing debt? Is it replacing equity? Or do you have new funds coming into the banks that lead to new investments? Now, with D'Angelo, I have this paper where we have kind of a beyond M1M world where banks make money from deposits. Now, in that model, banks have as liabilities, they have deposits, and they have equity. Well, if you are in that world, now if you substitute CoCos for deposits, it means that liquidity provision of liquidity by banks is going to fall, and franchise value is going to fall. Now let's look at the case where now you have existing debt and you have existing equity, and now you introduce CoCos. Okay, and so in this case, well, it's a windfall for the debt holders, okay, for the ones that remain, because the default boundary has fallen. So it's a windfall for the debt holders. The CoCos are zero net present value projects when they are issued. Now, you don't make any money as a bank out of issuing the security in the M1M world. And so if the debt holders get a windfall, and then it means that the equity holders have to lose. Now, there is no in between in this M1M world because the investment policy is kept constant. Okay. In this world, if instead you replace equity with CoCo, we are back to the same result, which is nothing happens to the debt. So from this, now you expect the spreads to fall if the CoCos replace debt, and not if they replace equity. If the CoCo replaces debt, then you expect the equity to lose. Now, so if you have an existing capital structure, you would never, as a bank, want to replace debt with CoCos because it would hurt the equity. Now, the reason you would be doing that, and the reason we are talking about CoCos at all, is because you have regulatory capital requirements. Those are increasing, and so the bank has to find a way to meet the new capital requirements. Okay? And so the bank then has a choice between issuing equity or issuing CoCos. Okay? So we have to think of this in the context of the capital requirements. And so now the bank could meet with CoCos. That implies an equity loss. It could meet the new capital requirements with equity, which again would mean an equity loss. Okay? Now, one thing that the paper talks a lot about now kind of the implications for risk-taking of the CoCos. Well, as long as you stay in this M&M benchmark, now the riskiness of the debt changes, but the riskiness of the assets of the bank doesn't change. Okay, so changing the CDS spread doesn't necessarily mean that the bank is going to take less risk on the asset side. Now, so there's then a puzzle, now, which is why is it that the banks would prefer to issue CoCos rather than equity? Now, they could meet the capital requirements either way. And so the paper really doesn't talk about that, but I think it would be worthwhile, and I think Patrick said that they are going that direction, which I think is good, in terms of informing the event study. Okay, I mean, a big dimension of that is just regulatory arbitrage. But in a way, now the regulators restrict payouts to equity in all the countries that I know, but I mean, we have some regulators here who could say more about that. But now in the US, if you're a bank, you can't just decide to increase your dividends or repurchase equity. Now you have to meet regulatory requirements. And I know for personal experience that the regulators can come and tell you you can't have more dividends, period. Okay? So the regulators can prevent you from paying dividend or purchasing equity. But if you have a CoCo with a high coupon yield, well, it means that you have payouts, but it's payouts that the regulators can't do anything about. No? I mean, it's contractual payouts. So I think now if you have CoCos, then effectively the bank is going to hit the default boundary faster than if it had equity because of the difference in the payout rate. Okay, and so I could see that as now at least one reason why they would prefer CoCos, and one that now kind of the models we talk about really don't seem to focus on, which may mean that it's not that it's worth thinking about. Now, another reason that might be in play that I think Patrick's paper talks about is if you issue equities, there is a drop in the value of equity now due to signaling effects. I'm not sure how important this is in the context of a situation where you have increased capital requirements. So everybody knows that you are going to do something. Okay, so everybody knows that you are either going to issue CoCos or equity. And so in the literature, there's actually a paper now which shows that if you issue equity in response to capital requirements, so people know that you are going to be short, there is really not a significant effect to equity issuance. Okay, but so what the literature, at least this literature tells us, is that it matters a great deal what people expect you to do, what the anticipation is. Okay, and that's an issue that Patrick's paper doesn't really address. But you could see CoCos having a big effect, but it's all in the price way before the issuance, because people know that that's how you are going to respond to the increase in capital requirement, and they know that you are short of capital with the new standards. Now, if you think of, he mentioned, it's always nice to have a presenter say Credit Suisse instead of what we usually hear. But no, everybody knew that Credit Suisse was going to do that quite a ways in advance. So by the time of the issue, there's really no information. Now there was a discussion if taxes, in some countries, CoCos are tax deductible, in other it's not. Now Patrick mentions the hybrid bonds in Europe, the US and trust preferred, which were very similar. We have a paper on that. Now, we don't find that differential taxes within the US explain much about trust preferred issuance. The last issue is, now if you're a banker, you think in terms of ROE. Okay? So CoCos have a different impact on ROEs on issuing equity. Now, effectively, it has less of an adverse effect than equity. Ignoring whether ROE is the right thing to look at or not, to the extent that they do, that's going to matter. The paper has much discussion about risk-taking. I think George talked about the issue of the conversion. What do you convert in? On that, there is a debate in the literature. I don't think I am going to skip, given that I'm running out of time, and George did a better job than I could. So let's talk about the empirics a little bit. Now they find no effect on equity. The effect on CDS is 8 basis points. Okay. Now, does that mean that we are sure that there is an effect? I'm a little bit skeptical, and I'm hoping that the authors can kind of eliminate my skepticism. Now, I think there's a problem of anticipation. There's a problem of, what is really the news to the investors when they issue them? But the last problem is 8 basis points is essentially within the bid-ask spread of CDS. Okay, and so that kind of makes you worry about the nature of the effect. The plot also makes me nervous for somebody who has written probably more event studies than he should have. Now, which is, in an event study, you expect the action to be here, t minus 1 and t. Well, that's not where it is. No? And so that's then you start asking questions. Now, suppose that the dealers buy protection to hedge themselves at the time of the issuance, and then they change their positions. Well, you could then expect something to happen at t plus 2 to t plus 10, but it might really not be a permanent effect on the CDS. No, it might be a transitory effect having to do with flows coming from dealers. There could be other things going on. But I think when you have a plot like this, you kind of owe it to the reader to say, well, here is now why we think that this is still consistent with the hypothesis. Patrick didn't mention Squam Lake. We have a chapter in the book on hybrid, so I thought I would come back to this. Now we call them regulatory hybrid securities. The CoCos don't look like that. Now, and that's despite of the fact that now the country that has gone all in on CoCos is Switzerland. But now the Squam Lake version had kind of conversion based on bank characteristics, but also based on kind of the existence of a systemic crisis. Now we needed, we required both, and we haven't seen that at all. Okay. Now the other thing, in terms of how we talked about things, both in Patrick's and in my discussion, now in Squam Lake, CoCos were part of a section on resolution. They weren't not on capital requirements. So conclusion in 9 seconds. Now, if capital requirements have to be increased, then CoCos are really a way to make that more acceptable to banks. Okay. Now, the CoCos that are most acceptable, you can't find a way to say that they reduce risk-taking. Now, so I mean, it would be nice for them to work harder on the reduction in CDS spread, but a reduction in CDS spread doesn't tell you much about what happens on the asset side. Now, the dilutive CoCos are the ones where you can make a stronger case that they might reduce risk. But as George pointed out, we don't see those. Now, Patrick has written on compensation in the financial industry, and he has a sentence in his paper about putting CoCos in deferred compensation packages. Squam Lake had statements to that effect as well. And then, now even the principal write-downs in compensation package would have an impact on incentives for risk-taking. Thanks.